What's going on YouTube? It's your boy Dollar Mike and I'm back at it again with another video. In today's video, we're going to be talking about some dividend stocks and just dividend investing in general. It's a lot of new people on the stock market, so we want to make sure we're all good when it comes to dividend investing and everything you need to know about dividend investing. So this is more of a beginner type of video, but I just want to bring some key factors about dividend investing in general that I think people should just know, and if you don't know, you might learn something in this video. If you already know everything in this video, then definitely drop a like and let me know to make a more in-depth dividend video going forward. But regardless, I just want to jump into pretty much 10 different key things that you need to know about dividend investing and dividend stocks in general to get you started on your dividend investing journey in 2023 and beyond, of course. So I'm not going to waste your time. Let's jump right into the video. Let's go. So before I jump into the 10 key factors of dividend investing, I just want to give you guys a little bit of background. If you don't know anything about dividends at all, we're going to explain that, and we're also going to explain why they get paid out. So let's start with dividends in general. A dividend is a payment from a company to its shareholders, giving them a portion of the company's earnings. Dividends are often paid out on a quarterly basis, meaning every 3 months, and in cash, or you can have the dividend be reinvested back into that underlying asset. But now, why do companies actually pay these dividends out? Because by all means, if a company is making some extra income, they could just keep that extra income for themselves and maybe pay themselves more under actual paychecks, or give the CEO more money. We've seen companies do this time and time again. So why do companies pay dividends out to their shareholders? It's a great question, and there could honestly be multiple different answers depending on the company, the situation, the financial situation they're in, or a couple of other factors. But generally speaking, a company is going to go ahead and pay those dividends out to their shareholders to essentially give their shareholders a piece of the profits. Pretty much a good faith type of transaction. Thank you for investing into us. So here's a little bit of how much we made over the past year or over the past quarter, if you say so. Or a company may feel as though they can't reinvest those dividends back into their own company to overall grow the company further in the long term or even in the short term. So they figure, since we feel as though we can't pay or can't grow the company with this amount of money that we have, let's go ahead and give some money back to the people that hold our stock. They could do that as well. Or it could be another reason where they are required by law to actually go ahead and pay some dividends out. In some industries, like the real estate industry, is required to do that by law, and we'll get into that actually later in this video. So let's use a little company known as Coke as this example. If you go and look at Coke stock and you want to go and check their payout ratio, right now it says their payout ratio is about 70%. Typically that is what you want. If you see a payout ratio over 100%, that means they're actually paying out more money to their shareholders than they actually can afford or pretty much are actually making. It's bad because a company is paying out more than they are actually earning, which of course cannot be sustained in a long term. You can't give people more money than you're making. It doesn't make sense in the long term, but in the short term it might be okay depending on what exactly they're doing. So it all really depends on your investment strategy, what you think of this company, and what this company has going for it for the long term. But if you're paying out over 100% on a payout ratio, then it's probably a bad thing, and the company probably can't keep that dividend up for you for the long term. These are also in no particular order of importance, but we're mentioning them today. And the second one I want to talk about is dividend yield. The dividend yield is the expected 12-month base return that you'll receive when you actually go and buy that dividend. When you go and purchase a dividend, there's a dividend yield number. There's pretty much a percentage, and that's the percentage that you'll receive when it comes to actually getting paid out that dividend throughout a 12-month period based on your own cost basis, or pretty much based on how much the stock costs at that particular time. So let's say, for example, you go and buy a company, that company costs $10 per share. If you go and buy that company and you're expecting to get $1 per share as a dividend payout, that means the dividend yield on that company is 10%, because you're getting $1 per share and each one of those shares costs $10. So if you divide 1 by 10, you get 0.10, and you round that on up to pretty much 10%. Dividend yield percentages do vary depending on the stock and the industry, but typically you can expect a solid dividend yield to be anywhere between, I would say, 1 to 4%, especially right now. You'll be able to find plenty of companies that pay a higher dividend yield, 6, 7, 10, maybe 12%, or even higher than that with a lot more risky type of investments. But typically the normal dividend yield, I would say anywhere between 1 and 3%, 1 and 4%, you can find on the stock market pretty easily. The next thing I want to mention is dividend aristocrats and dividend kings. Not too much concept behind these two, but a general definition should suffice. Either way, a dividend aristocrat is a dividend company or a dividend stock that's been paying out a dividend for at least 25 years straight, and that dividend is increasing. So 25 years straight and the dividend is increasing, and they also have to be a part of the S&P 500. If you guys don't know what that is pretty much the top 500 US companies on the stock market right now. So they have to be part of the S&P 500. They have to consistently pay a dividend out, and they have to consistently increase that dividend payout every single year for 25 years straight. That qualifies as a dividend aristocrat. So companies that do that typically are great companies. People like companies like that. People like getting paid out consistently without any worry in the world. That's very nice to see. And some examples are ADP, ticker symbol LOW or Lowe's, and also General Dynamics or ticker symbol GD. A dividend king is slightly different, and with a dividend king, they only have one parameter. So for a dividend king, all you have to do is pay out an increasing dividend for 50 years straight. That's literally it. You don't have to be a member of any type of S&P 500 or any other large index fund. You simply just have to pay out a dividend for 50 years straight and have that dividend be increasing for those 50 years. Some major companies or some big names, there's not too many dividend kings out there, but some big names that you already know is ticker symbol KO or Coke, ticker symbol CL or Colgate, and ticker symbol PG or Procter and Gamble. All these companies actually have paid out a dividend, I believe, for over 60 years straight, and have also constantly increased their dividend every single year, which is exactly what you want to see if you want to be a long-term dividend investor. Next up, let's talk about some DRIP. And no, I'm not talking about those red boots. I'm not talking about those red boots. We're talking about DRIP, or the Dividend Reinvestment Plan. This is exactly what I do with my personal portfolio on Robinhood, and that is known as DRIP. It's pretty much the act of getting dividends from dividend stocks, having those dividends that you receive get reinvested back into those same dividend stocks. So when you get paid out your next dividend, the next quarter or the next month or the next year, depending on when they pay the dividend out, when you get paid out that next dividend, the next dividend is going to add to the previous dividend, and pretty much it's just a cycle. It'll continuously keep building up. You'll build up your dividend snowball, and you'll, after 20, 30, 40 years, depending on how much you plan on investing and how long you plan on investing, you'll have a nice little lump sum of cash, and all that'll just be consistently reinvested back into that underlying asset, meaning you'll make more cash every single time you get paid a dividend. It's as simple as it gets. It doesn't get too much deeper than that, and that's pretty much how it goes. We're dealing with a lot in the world right now, and one of the major things we're dealing with right now is inflation. Dividends offer inflation protection. I say this because when you buy a stock, you can possibly make money off of that stock as long as the stock price goes up in value. If the share price goes up in value and you sell it for a higher price in the future than you bought it for in the past, then guess what? You've made money. But on top of the stock price going up, you can also make money by the dividend being increased, and also make money by the dividend simply being paid out to you on a monthly, quarterly, or yearly basis. So dividends do offer a little bit of inflation protection, especially if you're investing into some great dividend companies that are going to consistently pay you every single month or every single quarter throughout the entire year. Like the companies I mentioned before, like those dividend aristocrats and those dividend kings, those companies have been paying those dividends out very consistently. So it offers you a little bit of extra money, a little bit of extra buffer on your investment, on top of you also making money if the share price goes up. Something I learned early on in my dividend investing journey is that dividends can be cut without warning. Dividends are not guaranteed at all. So that's pretty much all I have to say. I don't have to dive too deep into it. Companies can cut their dividends whenever they feel like it for whatever reason. We've seen a lot of this happen, especially in 2020 when the whole, world pandemic kind of hit. A lot of companies lost a lot of money, and since they lost a lot of money, they couldn't afford to pay those dividends out to their shareholders anymore, so they just cut them completely. Some companies have brought the dividends back, and others simply have not just yet. Maybe they will in the future, maybe they won't, but dividends are not guaranteed. So if you are looking for a new investment, a dividend type of investment, then try to look for a dividend aristocrat or a dividend king, where even if something may happen that crazy, they can still afford to pay that dividend out, versus going for a newer company that might pay you a higher dividend, but they could cut it tomorrow or today. We're just talking about it. Could cut it today. Who knows? So yeah, dividends can be cut without warning. They're not guaranteed. That's all you need to know. Another thing that might interest you is that dividends do depend on the sector that you're investing into. So certain sectors are actually known for paying you reliable dividends, very consistent dividends. Even if they aren't a dividend aristocrat or a dividend king, certain sectors and certain companies are just known for paying out dividends because of what they actually are. Some of those sectors are the utility sector. So if you look at stocks like Chesapeake Energy, or just any type of energy type of investment, Exxon, they're just known for paying dividends. Past that, you can look at REITs or real estate investment trusts on the stock market, which we'll talk about in just a second. And lastly, you can also look at telecommunications companies like AT&T, which used to be the gold standard of dividend king investing, and they actually just cut their dividend when the whole pandemic happened. Or a company like Verizon. Other telecommunications companies works as well. Not all of them pay a dividend, but the ones that do typically is very reliable and very consistent. As I just mentioned, REITs, we're going to talk about just that. REITs. REITs stand for Real Estate Investment Trust. They are essentially real estate stocks on the stock market. So the main one that a lot of people like right now is ticker symbol O, and is for commercial real estate. So they invest into a whole bunch of different commercial companies or a lot of commercial real estate like LA Fitness, I think Walmart, they own some Walmart buildings, they own some Dollar General buildings, things like that. And all that money that they've received from that, all the leasing income or the real estate income that they receive for just owning the building, and then those companies actually giving them money, gets put out back to you as a shareholder by investing into Realty Income stock, which is ticker symbol O. But now REITs on the stock market are pretty interesting because it offers you a great risk and a great reward type of opportunity. When it comes to REITs, they are required by law to pay their shareholders, at least right now, 90% of what they make to shareholders, and they have a whole bunch of different tax benefits and tax rules and stuff in place if you are actually a REIT, I guess, type of company on the stock market. So they don't get taxed the same way as other companies like maybe Apple or Tesla may be getting taxed. They get taxed in a completely separate way just because of how they make their money and everything like that. So since they get taxed that way, we as shareholders get the benefit of getting a lot of passive income from them in the form of dividends because, like I said, they are required to pay out 90% of their pretty much earnings to us as shareholders, which is great, but also can be a little worrisome because if they aren't making a lot of money, they are still required to pay a lot of money out. And during a time like this where things are just happening every other day, you never know. So just something to take care of, something to look at. I wouldn't go all in on REITs, but it is an investment option that you can make, and it's honestly a pretty good one at that. I have a couple of REITs in my portfolio, like ticker symbol STAG or Stag Industrial, and I think I also have ticker symbol MPW, which is Medical Properties Trust, on my portfolio. They are all REITs and they all pay me on a monthly or quarterly basis. So yeah, can't really complain, but it is a little bit more of risk, a little bit more reward worth for it. So it's up to you if you want to take that risk, do your research on them and find out if that's the right type of investment for you. But yeah, it's definitely interesting. Another thing I learned early on in my dividend investing journey, which I honestly did not know about at all because I didn't do the research, but I'm telling you here because I know it now, is taxes. You will pay taxes on dividends. There's no way around that. I initially thought when you got a dividend, if you got the dividend reinvested back into the underlying asset, that you didn't have to technically pay taxes because you didn't pull the money out of your account or put it into another stock or anything like that. But regardless of what you do, however you pay, for dividends or however you get your dividends, you have to pay taxes on those dividends. Now, at the time, it wasn't that big of a deal because I didn't make that much money in dividend income to overall put myself in a bad situation, but it is something to know or something you should know about regardless of how you plan on dividend investing. You don't have to put the money back into the underlying asset. You can do that. It's an option for you. You can take that money out, have it go right to your bank account. That's completely up to you. Or you can just have the dividend come to your brokerage account and then put that dividend money that you just received into another stock like Tesla, Apple, Microsoft, whatever you want to do. It's up to you. It's all your money. So I can't tell you what to do, but I'm just letting you know you're going to pay taxes regardless. So putting it out there, and it's also different types of tax strategies and stuff like that. But I would definitely recommend that you talk to a tax professional about that. I'm not one of those. So don't go by me when it comes to trying to figure out your taxes. Talk to a tax professional. I'm not that guy.
Okay? You're not that guy, pal. Trust me.
You also may be taxed differently depending on if it's an ordinary dividend or a qualified dividend. So like I said, definitely talk to a tax professional about it. And we can dive deeper into that if you guys want me to make future videos talking about more key factors that you need to know about dividend investing. I'll definitely talk about that in a future video if you want me to. So definitely let me know down in the comment section below. Just type more down in the comment section below, and that'll be part of it. Type more, I'll make another video, another part 2, I guess you could say, to this, and we'll just keep it going. But either way, let's talk about the last one on today's list. And the last one on today's list is the ex-dividend date. You need to know the ex-dividend date. Why you need to know this? Because the ex-dividend date is pretty much the date that the dividend gets declared. So if you purchase a dividend, if you're just getting into a dividend stock, or you're just trying to start your dividend investing journey, and you want to make sure you get the payout is the next payout that's coming up when it comes to a dividend, it could be monthly or quarterly. You want to make sure you know the ex-dividend date, because if you buy a dividend stock after the ex-dividend date, maybe even a day or 2 days after, then you will not receive the very next dividend. You will receive the one after that. So just make sure you know the ex-dividend date for that reason alone. In order for you to go ahead and take advantage of that, you need to know the ex-dividend date and actually purchase shares in the stock that you're trying to buy at least 2 days prior to that ex-dividend date. And like I said, this is pretty much every single month or every single quarter, but it's a simple Google search. But I also use another website to check all my dividend research and just stock research in general, which is known as Seeking Alpha. Seeking Alpha is nice enough to be a channel partner, so if you guys want to sign up for Seeking Alpha and get a nice little hefty discount, the link will be down below in the bio. I use Seeking Alpha for almost all my dividend research, well, definitely almost all my dividend research, a lot of my stock research as well. So been using them for almost a year now, no complaints at all. I have the Seeking Alpha app as well, and that's pretty much it. Love them, can't complain. And they're also a channel partner, so we love to see that. They're all here for you. And of course, like I said, I'm providing you guys with a solid discount, so you don't have to pay full price if you just didn't have one. So completely up to you if you want to sign up, but I think it's pretty cool. I've been using it. I recommend it. Can't complain. It looks like that's all we got time for today when it comes to these dividend investing, these basic to beginner knowledge dividend investing type of key factors that I think you should know, and that I honestly didn't know about all of them until later on as I got more experience by just investing in general. So yeah, if you guys want to see another one, like I said, just comment more down in the description, or I guess the comment section below, and also like the video. That's probably one of the best ways that you can help and support the channel, and also support this video so it can get out to more people, so people can learn more about dividend stock and make some passive income if they wish to do so. That's really all I got to say for this video. I'll catch you guys in the next video. I'm out. Take care of yourselves. Stay safe, stay positive, stay hydrated. Dollar Mike. Peace. And if you guys didn't know, I make tons of content. This is late. It's all the way at the end, but I make tons of dividend content, so definitely check out the channel as well, and you'll be all good to go. I'm out. Take care of yourselves. Peace.